Hi there, it's Morris from selfimprovementmethods.com, and today we're going to be improving ourselves by making a little money on the stock market. Um, and by a little money, I mean a few $100s you can risk. This is um, all the money you're going to risk is a few $100s. So let me just explain what I want to talk about here. We'll go to Google and type in big charts. This is a free screener, and I like this one because it's handy. And oh, I think we have to put in something up here at the top. We'll put in like Disney. That's a nice company, I hear. So there's our chart. I like the advanced chart. And then I like to look at like 6 months and daily. You hit this, it redraws the chart. Notice it's kind of small. So we will do the chart style. We'll make it, let's see what big looks like. It might be a little too big. Yeah, that's good to see. Okay. Also, these are opening, high and low, and closing. I kind of just like to see just regular close, I think. Hit draw again. Yeah, that's nice because I like to see the wiggly lines. 6 months daily compared to, and I like to have a simple moving average. And we'll put that in here as, oh, say 7 comma 14 comma 30. Sometimes I use different numbers for that. I like to have Williams %R. Heard that guy talk, the guy that Williams. That was very interesting. I wasn't talking about a stock thing though. Okay. And there I did the MACD. Oh, there's room for another one. See, you can put 3 here. And I like slow stochastics. Now we'll see what that looks like. All right. See all those nice lines? And let me see if I can capture what those lines are in here. This really moving, well, the black line is the actual stock price. The light yellow orange line is pretty fast moving. That's the 7-day simple moving average. And the blue line is the 14 simple day moving average. And the big sloping one here is a 30-day moving average. So it takes a picture of the closing price over a period of 30 days. And then it's the last 30 days. Like, I don't know, is that going to show? No. Okay, so from 30 days and then 30 days and 30 days. So every day it's got a point of the last 30. So it shows you the trend. Now, notice there's a straight up here, which shows an uptrend. All right. So one thing you want to look at, I wonder if I can just copy this. I think I'll just duplicate that tab. That's good. And Disney is a New York Stock Exchange company. And let's just see what's going on with that. Yeah. NSE. It didn't carry my things. I forgot to say store my chart settings. Yeah. Okay. All right, so all we're doing here is just poking around at these settings. I just want you to kind of get a good look at it. This is, oh, I forgot my volume plus. That's all right. I like that one too. Okay, so the Williams percent are, you're looking for W's, which is figuratively speaking, there's a little W in there. And if you notice, it goes up and down and up and down, and then it'll whoop and shoot up. And just about that time is where the you don't really know what's going on here, and then boom, it's going to shoot up a bit. And it did, and then it shoots back down again. So there's the down. This is not the prices, but it's a computation based on the prices. So it's kind of to give you, it's called an indicator because it kind of indicates where the price might go later on. So this one is nice to show the trend because that's the actual prices. This one is showing you more of a calculation. The same with these other ones. They're all based off the price, but they're showing you different ways the stock's moving. So this one is kind of not a good example. Let's look at the semiconductors because that's a good indicator of the market. Hello, draw chart. Okay. Alrighty. Are we there? I guess we're here. Yeah. Well, look at that. The market's going up. Is this a surprise to anybody that the stock market's gone up? Huh. What is that? It's unresponsive. Ugh. How could it be unresponsive? This is not acceptable. Let's say that this one is non-responsive also. Okay, well, we'll just wait here. Okay, well, that's all very nice. Now I've unlocked my computer. We'll continue. All right, so here we are with the semiconductors. This is the stock symbol for that. And it shows that the stock market's going up. Now, what you can do is take $106 and buy one share of this stock. Let's find one that people might want to buy. What's this one? Nope. Gosh, sakes. How about that one? Coca-Cola Bottling Company. Now look at that. This one is not doing well. You can see it starts up here and it goes downward. So this is a downward trend. Oh, that's what I was talking about. Okay, so Coke is a part of the Nasdaq stock exchange, which is I can't believe that it didn't save this stuff here. Oh, that's nice. All right, so here's the Nasdaq, which is a stock exchange for technical stocks. I don't really know why Coca-Cola is part of the Nasdaq family, but at any rate, the Nasdaq is going up like a rocket, and Coke is going down like just hitting. This is below zero. This is a bad sign. This is a good sign that it shows that it's going back up, but look how it's crashing and how it's down below all of these day averages, 7-day, 30-day, 15-day. So we can see that the stock has turned back up again, but it's still in a toilet. So I wouldn't even consider this one because it's not matching the trend. You see, you've got the trend of its parent group the exchange, Nasdaq, and you can tell what group it's in because if we go back over to Coke, it says Coca-Cola is part of Nasdaq. So you're right there. Yeah. So the market is going up. Coke is going down. So Coke is going against the tide, kind of like. Let's see if there's something else here that's kind of nice. This is a stock that I didn't. I feel comfortable with this one. This is Newmont Mining. It's a gold mining company. And it kind of moves slowly. I kind of like it. So, but notice it's going up. And it is also, oh, no, New York Stock Exchange. Let's take a look at the New York Stock Exchange. This is going up. All right, so here we go up. Oops, what was that one? Newmont. Okay, so here we've got a stock that is going up, and we have a market that's going up. So those are two things that we want to have going. So you got the big picture and you got the medium-sized picture, and then you look at the actual charts to see. Look at this. For the last month or so, it's been going up faster than its. This is the 7-day average here. So this big acceleration going up here. It's right at this point here, which is like at the high point. So probably it's only going to go up another little bit, although it's in a strong upswing. So there's a very good chance that it might continue going up. See how it's just rocketing up here? And there's a little dip coming back up. Here it's going down. So you kind of got mixed signals here that it might start going down a little bit, but you get this overall trend showing up. So I would bet you anything. Well, I won't bet you anything. I'll bet you nothing, but you'll bet a couple of bucks. You're going to go to this place here called Option Chain. There it is. And today is mid-January, and you want to count from the third Thursday of the month. So this is like mid-January, so you wouldn't count January as a month. So you'll want to go out at least 2 months. So I would go to February. And these are called options here. This is the stock price right now, 39.47. And you need to buy 100 shares when you're doing options, and this is an option. This side of the fence is calls, and this side is puts, and this is where you're saying that you think the stock will continue going up, and this is where you think the stock will go down. When you're buying, we decided the stock will go up, so we're going to stay on this side of the fence. And when you're buying calls, you want to be in the money, which is a term that means underneath the selling price. So you don't want to go higher. Notice it's gray here. So here it would cost you $1.58 times 100, which is $158. Okay, that's good. You want to have a little bit of open interest. I prefer to have 100 open interest instead of just 12, but that's all right. It sounds good. If we thought that the stock was going down, see this gray area over here, then we would be out of the money just a little bit, and we would probably bid like around 126 or 130, and you got to buy 100 at a time, so it's $130 if you're going over here. But again, we're going to assume that the stock is going down, or going up rather. So here it would cost you $158. Now, if you have to buy 100 shares, and that's why it's $158. But you can, if you bought 100 shares of stock, then what would that be? $3,900, right? Yeah. So you would have to lay out $3,900 and hope that it goes up a little bit. We figure, what do we figure here? Let's go back over to this. My point and why I like options so much is that you lay out that little bit of cash and the stock moves almost the same amount as the options move. The options move the same amount as the stock. So here, if we're figuring it's going to go from 39.5 to maybe 40.5, that's a dollar move. If you were buying options, you would probably see close to a dollar move in the option also. So it would be, let's see if I can see into something that would help a little bit. The difference between 39.5, 38, 37. Well, here, if the difference between 37.5 and 39.5 is $2, and the price of the option goes from 158 to 258, which is a dollar here. So what you have to lock up $158, and you might make close to a dollar in on that 158. So if you bought the stock, you got to put out like almost $4,000 to make that same $100. See what I'm going at here? So if the stock goes from 158 to 258, you made $200, right? If you bought an option. If you bought this stock and it goes from 39.5, you got to put out $3,900, hoping that you're going to get, the $100. So not everybody has $3,900, but you can pretty well come up with $158. So this is all done by, it's called trading options. This is not company options like an employee gets. Of course, this is just another way of buying stock. Now, people say that it's risky, but it's not really, because you can get out of this at any point. And that's why we picked a month like March, because when it gets to its expiration date, which is March 3rd, Thursday in March, this will become worthless. So, and by that I mean zero. So the worst case scenario, you've lost $158 on this trade. But if you start getting cold feet in February or beginning of March, you can sell it for whatever price it is at the time. So you're not going to lose the whole thing if you get cold feet. If you just totally blew it and it went in the total wrong direction. So at any given time, you've only risked that amount that you set out there. It's like putting money on a gambling table. This is how much I'm gambling. But the returns are very good, almost equal to the returns if you had bought the stock. But you're only risking $158. You're not risking the $3,900. Just like the $3,900, if the stock starts dropping down, you sell it, right? So, or you just hold on to it. There's a lot of people do that too. And if it is working its way down, like CocaCola we saw, then it just gets worth less and worth less, but it's never of zero value. The option is going to expire at that date you pick. So there's these things to weigh, but still, I think if you want to get cold feet and you bail early, you can still not lose all your money. if you picked it right, then you're going to make uh, as much money as if you were risking $4,000 on this trade, but you're only putting in like 158. So this is what I suggested you do. Look into options. And when you're starting out, I would suggest that you look for stocks that are going up, that you plan on that have an uptrend, and that they match their market, if it's the Nasdaq or the New York Stock Exchange. Um, I would stay with those. You want the big market to be going up. You want your little stock to be going up, and you want the current uh, period of time to be going up also. Or you could do the opposite and have the whole market going down, your stock going down, and the current period of time of the stock going down also. So, but this last year has proven that the stock market is going up. So I wouldn't buck the trend. So get on the case. So that's why calls are what I'm recommending, because the stock market is doing good, stocks are doing good. So let's bet that um, it will continue for the next couple of months, right? So that's a good thing to do. So I hope all this has just at least perked your interest to look into stock options, uh, so you can join in the stock market, and you're only doing this for a couple of months, and then the thing's gone. So that's what I suggest you do, and then you maybe make $100 here and there. It's a good thing. Why not? All right. So if you like this video, click the subscribe button down at the bottom. Um, like, share, comment, and I got a free gift for you at selfimprovementmethods.com/go. So enjoy yourself and look into this stuff, because it's, if anything, it's fun, and you don't have to actually put money. You can get a little piece of paper and just see what would have happened. Just to try it out, see how you're going. If you're interested, I know a great guy that's got some super training, but I'm not even going to mention that at this point, because I want you to just see if this is something for you. It's easy to get into, and anybody can open a brokerage account. It's as easy as opening a bank account. So, all right, well, have a good day and make it a good day, and I'll talk to you later. Bye.